Hi everyone, the UK is sending some seriously mixed signals when it comes to the future of crypto and digital innovation. On one hand, the Bank of England is proposing strict, heavy-handed limits on stablecoin holdings, a move that's been rightly slammed by crypto groups as a major step backward. But on the other hand, the government's just signed a landmark technology deal with the US, unlocking tens of billions of pounds in private investment for the UK's AI and data infrastructure. So, what's the real story here? Is the UK slamming the door on digital assets, or is it quietly building the foundations for a pro innovation future? In this video, we're going to dig into these conflicting signals. We'll unpack the Bank of England's controversial proposals, look at the FCA's slow progress, and then explore what this huge US UK tech deal could mean for the future of crypto in the UK. Before we start, just a quick reminder that nothing contained here is financial advice. Let's jump into the video. In November 2023, the Bank of England released a discussion paper detailing its vision for a regulatory framework that would govern stablecoin usage in the UK. The overall goal of the ideas presented in the paper is to position the Bank of England at the heart of the stablecoin sector. In the Bank of England's view, this level of oversight would support innovation. However, since 2021, the Bank of England has been exploring the possibility of setting up central bank digital currencies, or CBDCs, in the UK to pave the way for a digital pound. So could they do this through stablecoins with a digital token pegged to the pound, or in other words, a digital pound? Because unlike decentralized stablecoins, a Bank of England-backed CBDC would be fully controlled by them, raising big concerns about a lack of privacy, freedom, and innovation. And we learned on September the 15th, 2025, that the Bank of England is planning to impose hard caps on stablecoin holdings in the UK at £10,000 to £20,000 per person and £10 million for businesses who are using stablecoins in the UK. And it's for this reason that crypto industry groups are rightly raising the alarm over this stablecoin cap proposal. For example, Tom Duff Gordon, Coinbase's head of international policy, said that slapping caps on stablecoins is bad for UK savers, bad for the city, and bad for sterling. Also, Ricardo Tordera Ricci from the Payments Association asked why the regulator would place a cap on stablecoins but not on cash or bank accounts, which is right because it's moving more towards the stringent regulations of the EU that recently announced it was imposing holding limits on the digital euro and seemingly away from the US, which we'll come back to in a minute. And this is taking place at a time when the UK government announced its recent plans for a mandatory digital ID scheme, which again add to the large concerns of mass surveillance, control, and a lack of privacy and freedom, with over 2.8 million people signing the petition against introducing this digital ID in the UK, which the government said on the 2nd of October it was proceeding with regardless. And if we now compare this with the US, we know that the US SEC's role in regulating stablecoin issuance is clear, with the Genius Act enacted on the 18th of July. Fiat-backed, one-to-one pegged payment stablecoins aren't securities, and so their issuance is under the Office of the Controller of the Currency, or OCC for banks, the Federal Reserve for non-bank issuers, and state money transmitters or trust companies like Circle. So issuers now have a clear path without fear of SEC lawsuits labelling their tokens as unregistered securities, and this clarity cuts legal costs and speeds up market entry. However, in the UK, the FCA, under the Financial Services and Markets Act 2000 and the 2025 statutory instrument, has a broader and more centralised role in regulating stablecoin issuance, hence the ongoing challenges to achieving regulatory clarity. So, for example, the FCA doesn't explicitly exclude stablecoins from investment-like regulations, but by failing to do so, the regulator creates uncertainty for issuers offering innovative features, such as tokenized funds. Another big point is that the regulator's broad role covers token issuance, custody, and financial promotions. This setup requires issuers to navigate strict FCA and Bank of England rules, contributing to the UK's crypto sector lag. And then The Bank of England proposes that stablecoin issuers must have a UK presence to ensure direct oversight by the Bank of England and compliance with UK laws, which of course slows down international firms that wish to enter the UK market. On top of that, the Bank of England's framework exclusively targets GBP-denominated stablecoins for payment systems. Now, this would have been great had they supported the growth of British pound-pegged assets in the first place, but here's the reality. Pound sterling denominated stablecoins, pegged 1-to-1 to GBP, emerged in about 2018. The issuers targeted UK, EU payments and DeFi, serving as a hedge against USD dominance. Unfortunately, their growth has been choked by intense scrutiny, low liquidity, and post-Brexit challenges. So as we speak, there are only 2 GBP stablecoins that you can see on CoinGecko due to limited demand and regulatory barriers, with only one having a market cap of just £425,000, whereas the US dollar stablecoin market size is over £228 billion at the time of recording this video. What this means is that the Bank of England has reason to worry over the dominance of dollar-pegged stablecoins, and this is why it's argued that restrictions are needed to prevent outflows of deposits from UK banks that could weaken credit provision and financial stability. But the blame lies squarely on the regulator's doorstep. True, the Genius Act is reinforcing the dollar's global reserve status. However, it achieves this by maintaining a laser focus on innovation and market competition, rather than issuing risk-averse controls that undercut token issuers. So moving on from the Bank of England now, on September the 17th, 2025, the FCA released a proposal seeking feedback on the minimum standards that crypto firms will need to comply with in the UK. At first glance, this might not seem like big news, but the substance is in the details, because the FCA is proposing a tailored regime for the crypto industry, which is a significant step. On one hand, the proposal aims to apply core principles from traditional finance to protect consumers. This includes enforcing the consumer duty, requiring robust operational resilience, and implementing strong anti-financial crime controls. But on the other hand, and this is the crucial part, the FCA is also suggesting it could waive or exempt crypto firms from certain existing rules that are a poor fit for the industry, such as some of the rigid market integrity and disclosure requirements designed for traditional securities. This shows the regulator is hopefully moving away from a blunt, one-size-fits-all approach and is attempting to create a more proportionate framework. This is a bit of a double-edged sword for the UK's crypto market though. A clearer rulebook is good for trust and may attract large global crypto firms into the UK. However, the compliance costs could also squeeze out smaller startups, particularly those innovating in niche areas like privacy wallets or DeFi. Ultimately, this proposal is a step towards creating a clearer, comprehensive framework, but the final impact will depend what feedback it gets from the industry and what the FCA actually does with it from the proposal that's due by November 2025, by the way, and with its final rules expected to be put out in 2026. Building on from that, in yet another attempt at a course correction, the FCA is accelerating the registration of crypto firms after a massive slump in applications and after years of incredibly slow approvals, which I have covered in previous videos, because crypto firm applications in the UK have fallen to record lows, from 46 in 2022 to 2023, to 28 in 2023 to 2024, and 26 in 2024 to 2025, with actual approvals dropping from 8 in 2022 to 2023 to 3 in 2024 to 2025, which includes BlackRock and Standard Chartered. So the FCA is accelerating the registration of crypto firms to 45%, compared with just 15% over the previous 5 years, by offering free pre-application meetings, plus roundtables and webinars for guidance and support. On top of that, they're setting up faster authorization targets, cutting the statutory processing time from 6 months down to 4. So we can only hope that this isn't a case of closing the barn door after the horses have already bolted, but with some companies possibly waiting until after the UK crypto regulation has come into force in 2026 before acting. According to the founder of the UK Crypto Asset Business Council, Simon Jennings, even multi-billion-dollar giants like Coinbase wait years under the current approval system, warning that these firms won't wait around forever. And before we move on, let's look back at the UK Chancellor, Rachel Reeves' Mansion House speech on November the 14th, 2024, about a year ago, in which she admitted that post-crisis, financial sector regulations had gone too far, saying that the UK had been regulating for risk, but not regulating for growth, which I agree with. By her own admission, the UK financial system watchdogs have built a system obsessed with erasing every aspect of danger that's gone too far, leading to unintended consequences that choke competitiveness, but which must be addressed. So she unveiled reform strategies to supercharge investment and remove the red tape nearly a year ago. But looking at the ongoing events in the crypto asset sector, we can agree that the UK regulators still have some way to go to be pro-innovation, although opening up retail access to crypto ETNs was a positive step forward. So to bring all this together, the UK's inability to move with speed and innovation over a period of years is conceding monetary sovereignty and financial leadership to countries that have moved faster. To put it another way, over-regulation has potentially cost the UK and Europe chances to redirect liquidity towards their currencies and challenge the dollar. And besides eroding monetary sovereignty, this has also increased foreign exchange costs and sidelined local fintech firms. But let's end this video on more of a positive note, because amongst all the regulatory stuff that we've looked at in this video, there was a significant development on September the 18th, 2025, when Donald Trump and Keir Starmer signed the US-UK technology prosperity deal. This isn't just a political handshake, it's a landmark agreement that's unlocked a huge amount of private sector investment into the UK's tech infrastructure. For example, Microsoft has pledged a record-breaking $30 billion, or £22 billion, over 4 years to build the UK's largest supercomputer and a network of new AI data centres. On top of that, Google's committed an additional £5 billion, including a new £1 billion data centre in Essex, and US asset management giant Blackstone has pledged a staggering £100 billion over the next decade to develop data centre capacity across the country, with the UK government putting on its website that there'll be a record-breaking £150 billion investment in the UK in total. Now, while there's no direct mention of crypto in the deal, the sheer scale of this investment is significant due to the impact on technology in the UK as a whole. This therefore makes it strategically and politically harder for regulators like the FCA and the Bank of England to maintain an overly restrictive stance on other emerging technologies, including crypto and blockchain. So the real value here isn't a direct investment in crypto, but a fundamental shift in the UK's strategic direction, one that's now hopefully backing the infrastructure of the future. This creates a much more favourable environment for all forms of digital innovation, including the digital asset industry, particularly as the UK and US will be working together, with Rachel Reeves and Scott Bessent, the US Treasury Secretary, announcing another partnership between the UK and US called the Transatlantic Task Force for Markets of the Future. So to summarise this UK crypto update video, the UK crypto space is caught between two opposing forces. On one hand, we have the Bank of England proposing restrictive, heavy-handed caps on stablecoins, a move that puts the UK out of step with the pro-innovation approach we're seeing in the US. This is compounded by the FCA's historically slow pace, although its recent proposal for a tailored regime is a small step in the right direction. But on the other hand, we have the huge US-UK technology prosperity deal backed by tens of billions in private investment, which signals a major government push towards innovation that could create a more favourable environment for all emerging technologies, including digital assets. The key takeaway is that the UK is at a crossroads. It must decide whether to continue with cautious, risk-averse regulation that stifles growth, or to fully embrace the pro-innovation spirit of the new tech deal and secure its place as one of the fintech leaders. Just a quick reminder that I do offer one-to-one coaching to those who are genuinely looking to educate themselves in the crypto space, with there being links in the description of this video to contact me and booking a free call to see if we'd be a good fit. And as always, I'd love to know what your take is on crypto in the UK currently, and the latest developments we've covered in this video in the comments below. So please add a comment, subscribe to the channel, turn on all notifications and like this video, as it honestly makes a big difference and does help the channel. If you're looking for an easy way to track and stay on top of your crypto investments, you can check out CoinStats, which is the leading cryptocurrency portfolio tracker. And you can find the link to their official website in the description of this video. There's also Coinly, which is one of the best automated crypto tax platforms out there. And you can sign up for a free account using the link provided in the video description. If you're looking for more personalized support with your crypto taxes, Miner, a part of the Nephos group, is one of the leading UK crypto tax accountancy firms that provides expert crypto tax advice, as well as services such as wealth management, restructuring and offshoring. And you'll find a link to contact them directly in the description of this video if you'd like tailored support with your taxes. And for our US viewers, there's a link in the description to contact Crypto Tax Audit, a leading crypto tax company in the United States. So if you need any help with your crypto tax planning, definitely check them out. But thanks for watching, and I'll see you in the next video.